Hello, welcome to a Sunday afternoon edition of the Nick Talks Money Q&A live stream. Just posted a new video. It's only like 20 seconds long, so if you haven't seen it yet, wanted to go give it a look, I promise you I will still be here after you've watched it. I'd appreciate it if you go over there, give it a little quick handshake emoji down in the chat to let me know that you came over there from the live stream. I'll make sure I show you some love. Give it a like, share it with your friends. This is a nice little lighter Sunday edition, basically saying, hey, school doesn't teach you anything about money, but thankfully we have this thing called the internet and random internet people like me who are spreading our financial knowledge. So with that being said, this is a Q&A video. So you ask questions, I answer them. Without questions from you, I'm not going to say anything meaningful. So yeah, what do you guys want to talk about today? We could do any questions about money, investing, taxes. Everyone loves taxes, cryptocurrency. I got a parking ticket the other day. That's fun. We could talk about that. It's finally going to be warm in the great north here. So hey, we can talk about that too. Hey, Andre Series 12. Sorry if I butchered that last name. Says, what's up? Hey, appreciate you being the first commenter here, Andrew. Nothing's up really. Hey man, pretty lazy Sunday. We got a lot of videos, recorded a lot of videos yesterday, so we got a lot of fire content coming. Oh man, we're burping again. The live stream burps always hit without fail. But yeah, we got a lot of videos recorded yesterday, so a lot of content in the pipe. And yeah, hey, we got our first real question once again from first of all, let's shout out to user 184 994 for saying hi Nick. Hey, user bunch of numbers. And now for our first real question. Andres asks, what are capital gains taxes for real estate? Yes, this is a fantastic question and one that you need to know if you want to get into real estate one day. Just so you know, I'm not a licensed real estate agent, so these are numbers off the top of my head without actually having participated in real estate transactions before, but I'm looking into getting into the space. I'm actively trying to get into the space, so I've done a lot of research on it, and obviously we had to learn all about this stuff for my CFP qualification. But essentially, if you buy a single family home and you just use this home as a personal residence, essentially, as most people do for like 10, 20, etc., certain amount of years. I mean, you really only need to use it for a personal residence for 2 out of the 5 years before you sold it. And if this applies to you, if you're a single person, up to $250,000 of your gain is tax-free. And if you're married, up to $500,000 of your gain is tax-free. So with all that being said, essentially what this means is if you buy a house and you use it as a personal residence, if you sell it for a gain in the future, as long as you've lived in it for at least 2 years over the past 5 years, you just aren't going to get taxed on it. Now for investment properties, this is a little different. What happens here is they're subject to Section 1250 gains, and essentially, if I remember this correctly, they're at long-term gains rates, but the thing is, you don't usually have to worry about real estate taxes or capital gains taxes on real estates, even if you are using them as investment properties, because of something called a Section 1231 exchange. And essentially, what this means is if you sell a property for a gain, as long as you roll this gain, roll these proceeds into a different property within, I think it's like a 90-day, 180-day window, like it might be half a year, so 180-day window. As long as you roll these gains into another property, your capital gains taxes are deferred. That's what I meant. 1031 exchange. Sorry, I said 1231 because I thought about 1250. Thank you, Seals McGee. Keep me honest out here. 90-day. Yes, thank you. But yeah, as long as you roll these funds into another property, then hey, those taxes are deferred. And then most real estate investors, they never end up paying taxes on their real estate gains because they take these deferred gains to the grave, and you basically just never have to pay taxes on them as long as you do it correctly. But Declan Bryson says, hi, how are you? Love your videos. Hey, doing great, Declan. Thanks for hopping on. Nikki Vet, hey, welcome back, Nikki. Hi, Nick. Steels McGee, thank you for keeping me honest out here. Colin Raup, how did I become a financial advisor? Yeah, so I went to school. Well, first of all, I developed a big passion for personal finance. I mean, as you can tell, I have a TikTok channel called Nick Talks Money. I'm talking about personal finance all day, every day. I mean, yeah, I developed a passion for personal finance probably when I was in high school. Basically, if you guys haven't heard the story, I became a YouTuber. Basically, I was a gaming YouTuber when I was like 15, 16, made a decent amount of money on there, but I really had no idea what I was doing with my money. And add that on top of the fact that my parents really didn't have a financial education in their households growing up, so they didn't really know a lot about what they were doing with their money. And I was like, hey, I mean, there has to be a way that I can like effectively use this money to improve my life instead of just spending it. Like I knew the stock market existed, but I didn't know exactly what to do with it. I didn't even see like real estate investing as a possibility at that point. But I was like, hey, like I'm gonna start reading some finance blogs like Mr. Money Mustache and Financial Samurai and Millennial Money, and I just started really getting a further understanding of personal finance, and I really got a big interest in it. And I was like, whoa, this is like really fun to learn about because it actually helps me improve my life. And I was like, hey, like why keep this information myself? I want to share this with other people. So I went to school, went to college, got a degree in finance, I explored the corporate finance route, but I was like, man, I hate this stuff. I hate going into a cubicle every day with a Fortune 500 company with like thousands of employees at the same job site and just plugging away numbers into an Excel spreadsheet all day, doing corporate accounting, corporate finance. It's not fun. So I decided, I was like, hey, they offered me a job after my internship, but I was like, no thanks. I'm going to go try to find a job in financial advisory. And the reason I didn't go into a job in financial advisory right away is because, I went to a Big Ten business school, and essentially what they do, they take a bunch of donation money from Fortune 500 companies. So they really push you into joining a Fortune 500 company because that's who they get their money from. So they basically just mold you to be a perfect corporate employee and push you out there. But I was like, man, why would I do that? I want to go, one, learn more about personal finance myself, and two, help others live better financial lives themselves. So I was lucky enough to land a job at a very small financial and tax consulting firm. Minneapolis, doesn't matter, but and then I basically learned a lot on the job. Since it was so small, I was able to interact with clients from day one. We do serve high net worth individuals, so I'm not really helping people escape poverty or anything, which is really part of the reason why I made this channel. We can go down that rabbit hole a different day. I got hands-on experience with clients, and basically my boss was like, hey, if you want to get taken more seriously in the space by our clients, then you should think about becoming or taking the CFP exam and taking the EA exam, which is a tax examination. And as is the case with a lot of different employers, different financial advisors, they offered to pay for all my certifications. So basically, I got my EA certification first. It basically just says the IRS licenses me to prepare tax returns. No easy task. It's a pretty tough exam. It's 3 different exams, pretty tough. But I got that. And then since the CFP had a 3-year work experience requirement, I waited about 2 years after I graduated college to really start studying and take the exam. And I finished that exam a little over a year ago. So yeah, I've been licensed CFP for a little over a year, but I've been an actual financial advisor for like 3.5, almost 4 years now. Not almost 4 years, like 3.5 years now. Yeah. It's basically just set your intention. Like, hey, that's something I want to do. Start exploring options within the career options within the field. I would recommend that you go with a smaller firm. Just because you get a lot more direct exposure, it's a lot less BS. I know other friends that I worked with, that I went to school with, econ majors, finance majors, etc. They wanted to get into the space too, but they ended up going with big financial advisory companies, and it sounded like all of them hated them because they basically get put into a call center for the first year or two and just deal with angry customers all day and don't really learn a whole lot and are pushed to sell certain securities. So I'd say, hey, try to find a local fee-only financial advisory provider. This means that they don't sell any financial products, because when you sell a bad financial product, because you're the one selling it, it becomes the best financial product on the market. So you push that to clients, and you probably don't really feel good ethically about that. But yeah, that's actually my story of how I became a financial advisor. Let's see. Steven McGee, thanks for being such a mainstay in my lives here, asks, even better in a self-directed IRA. Yeah. Not sure what you're referencing there, but yes, self-directed IRAs are fantastic. Vicky Vet says, can I withdraw money out of a high-yield savings account whenever I want? Yeah, every high-yield savings account I've come across has that feature. There may be some, I'm not aware of any, but there may be some that maybe lock up your money for certain periods of time. But yeah, high yield savings accounts, great place. For those of you who don't know, they're a great place to put your money instead of a regular savings account that you probably have with your standard bank, because high yield savings accounts actually pay you interest. So your money can actually kind of keep up with inflation because it's not invested in the stock market, and it needs to stop from losing value somehow. Whereas with regular savings accounts, like at my bank, like TCF Bank, or at like US Bank, any other big bank that you can think of, essentially, if you have money in a savings account, it's losing 2% of its value every year because of inflation, if not more, if not 2.5%, if not 3%. So having a high yield savings account is a great option you need to have cash sitting around. Like the standard theory is you need 3 to 6 months worth of essential expenses saved in cash as a emergency fund. So a great place to put this emergency fund is in a high yield savings account, because it'll do its best to keep up with inflation. I mean, rates are super low right now, so it's not going to 100% keep up with it, but it's going to be better than nothing. It's going to be a lot better than nothing, because they pay like 50 to 60 basis points, but you guys probably don't know what that means. 0.5% to 0.6% in interest every year. So I mean, it's not great, obviously, but it's a lot better than zero. Andres asked, do you have a YouTube channel? Yeah, I do. I haven't really posted anything on there yet, but I do have a couple videos on there. They're basically saved versions of live streams, and then I did one exclusive Q&A session, but they are all private because they're only available to members of my Patreon page. You can check that out, link in my bio. I don't want to make this whole Patreon ad sell, but if you're interested in getting more exclusive content from me, that's available on Patreon. That's currently where all my YouTube videos are living right now, but you can go to YouTube, Nick Talks Money, same username as I have on here. It's also linked in my bio if you just want to click on it in there. And you can subscribe for when eventually one day I will start making videos on there. It may have to wait until I can make this thing my full-time gig, but we'll see, because YouTube content, man, that takes a lot more time to produce than TikTok content does, for better and for worse. So I can't start pushing that out there until I have a lot more time on my hands. And it's currently busy season at work. We're preparing tax returns. So we are not quite at the time freedom space yet to start consistently making stuff on YouTube. And when I do start making stuff on there, I want to make sure I can go in 100% so I can give you guys consistent stuff on there as well. Because I know it sucks when you subscribe to somebody and they post like one video a month, even though they said they were going to post like 8 videos a month. So I don't want to make sure that's not me. So yeah, you can go ahead and follow me on there at Nick Talks Money, but nothing quite on there yet. FHR Slug 10 asks, is it okay to hold blue chip stock for long-term investing instead of ETFs? I mean, yeah, it's okay. You're probably not going to lose money there, but the real question is, are you going to make more money than the market does over the long term? And the answer to that is probably no matter what company stock you're holding. Even if you're holding something like Apple, even if you're holding something like Walmart, even if you're holding something like Amazon, there's just no telling whether these companies are going to outperform the market over the long term, or if they're already mature businesses and they're just simply not going to grow that much over the coming years, and their stock price won't grow as much either. The data shows, if you want to just go with the smart data-wise decision, shows that they won't consistently outperform the market over the next 10, 20 years. The market's going to outperform them because there's going to be new hotshot companies rising up the ranks and everything, yada, yada, yada. I mean, there could be individual problems with a certain business, like maybe Walmart is like the combination of like Amazon, Target, local grocers, etc. may push Walmart to the brink and might devalue their business. Tesla might get beaten in the electronic vehicles race, or the affordable electronic vehicles race, the autonomous vehicles race. And they can simply become an afterthought in the entire world of EVs and autonomous vehicles. So, I mean, there's no guarantee that any company, no matter how hot it seems right now, is going to continue to outperform the market over the long term. And the data says it's not likely that they will. So, yeah, I like putting all my stuff in ETFs like VTI, IGOT, SCHB. But, I mean, if you have a couple blue chip stocks in there, I can't fault you for it. It keeps it interesting. JJ Ruiz 4 says, I know you preach ETFs. What individual stocks do you personally own or recommend investing in? None. I would say just invest in ETFs. I've told the story before, so apologies if you heard it before, but I have invested in one single stock, and it was a stock I was intimately familiar with. I watched it every day for like probably a year or two before deciding to invest in it. And the reason I decided to invest in it is because the month prior, or 2 months prior, whatever it was, it went up to about $260 a share. And so it was, pretty good value. It was steadily appreciating until then. It shot way up, and then it came crashing down to like 190, 195, and then it went back up to 220 basically within the week, and then it crashed back down again very shortly afterwards to like 190 and 195. So I was like, hey, I'll just invest into like 5 shares of this thing, make a couple $100 real quick after it bounces back up to 220. And then what happened? It didn't go back up. It never even crossed 200 again. It just kept going down and down and down and down until I think it bottomed out at like 130 or something. And then it, kind of middled around 150, 160 for a year or two. Like literally, I was down money on it for a year or two. And then just within the past couple of months, even couple of weeks, I think it's back above 200 again. So I probably should sell it, just divest away from it and just put that money back into indexes. But the one upside of the stock is it does pay a really healthy dividend. That's the downside. This is a very well-known, like Fortune 100 company. So I would say like, hey, no matter how good the company's track record is, no matter how good their future appears to be, there's just simply going to be things you just won't ever foresee coming, whether that's business specific or within the market, that's going to affect the business's stock price. It might drastically reduce their value. And the way you can avoid this business-specific risk is by investing into every single stock through ETFs, which is why I like preaching ETFs. It's the stress-free and the winning way to invest. I mean, it's not completely stress-free because, if you're someone who gets stressed when the market goes down, that's still going to happen. But just, rework your framework and be like, hey, if the entire market's down, I should just be buying more because everything's on sale right now. But you don't have to worry about like a bad piece of news coming out about a company. You don't need to worry about competitors to a certain company because you are invested in the entire U.S. stock market. If you invested in an ETF like VTI, ITOT, SCHB, so you're invested in Tesla and all of their major competitors. You're invested in Walmart and all of their major competitors. So if anyone wins, then you win. If the industry as a whole is doing well, is increasing in value, then your portfolio is going to do well and increase in value. So yeah, I don't recommend investing in individual stocks. Everyone thinks that's the way to go. But this is coming from a licensed financial advisor who practices what he preaches and literally tells our multimillionaire clients to invest the exact same way. And those that do outperform those who still insist on investing in individual stocks because, hey man, if you're investing in individual stocks, there's just so many things that you're not taking into account. You have to compete against the guys on Wall Street, the trading algorithms run by multi-billion-dollar hedge funds, all these different things, especially if you're day trading. So I would say, hey, stay away from individual stocks. It's not the way to go. You're going to be a lot more stressed than their returns will justify. And then a good follow-up question. Good morning, lads. Hey, thanks for hopping back on the live stream. Asks, is there a right time to buy ETFs? Yeah, consistently. if that's the time, the timing is consistently. I'd say, hey, every month. Like if you get or even if you get paid, like, hey, bi-weekly, every time you get your paycheck, it's a good idea to just, hey, dump a certain percentage of that, a certain amount of that every single time you get paid, just right into ETFs. Consistently, I would say, timing the market is impossible. Nobody can consistently time the market. If you ever end up doing so, you just got lucky. Because, hey, look at over a year ago now, pre-COVID. Let's say, hey, January, February, before COVID was really a big thing. The market was on fire. Nobody thought the market could do anything wrong. And then what happened in mid-March? Boom! Way down. So if you invested in early March, you were like, oh, yeah, I'm investing it at highs right now. The market looks really good. Like, it's going to go nowhere but up. And then what happened? It went all the way down. But I would say, hey, the perfect time to invest in ETFs is when they're all the way down. But when do those buying opportunities happen? Once every 10 years, essentially, if even. The last time it was such a good buying opportunity was back in like the 2008 recession. And then before that, probably in like 2001. You can't rely on these events to make basically all of your investments. All you can do is just keep consistently investing and then get the average of the stock price over the time that you've invested in. And over time, ETFs, the entire reason we're buying them is because the market as a whole increases about 10% every year. So you want to make sure your money is actually in the market making these returns because you can bet that on average over the long term, your returns are going to look like this. They're going to go up and to the right because the market appreciates on average about 10% every year. So we want to Make sure your money's not sitting on the sidelines. The most dangerous thing that can happen is having fear of investing because either the market's too high right now or it is too low right now. You don't even want to look at the stock prices. Just keep throwing money in there because you know you won't need this money for at least 5+ years, and you're confident that the market's going to continue to increase. And there's a lot of people, there's a lot of stories, I'm sure you've probably heard of them. People after like the 2008 housing crisis, and I'm sure a lot of people right now during COVID. I saw it with a couple of our clients at my day job, even though against our strong advice, they sold when stocks were low, basically like near end of March and April, when stocks were still super low after the whole like 10, 20, 30% dip happened. They sold, or they converted their 401ks to cash. And guess what happened shortly after they did that? The market started to recover and it started going back up. So they were sitting there like, shoot, man, I just lost out on like 20% in returns because I converted my stock to cash when the stock was low. And then they just get scared because they're like, oh, hey, I'm just going to wait till the market gets back to where it was when I got out of it before I reinvest. And guess what? The market has not yet gotten back down to those lows. In fact, it's at all-time highs right now. And they're just sitting here like, man, I really wish I wouldn't have done that, and I'm just going to wait till the next big recession happens until I put my money back in. And people that did that after the 2008 recession would have had to wait until 2020 to put their money back into the market. And over that time frame, they lost a absurd amount in gains. So the best thing you can do is just keep investing money into the market regardless of what the market conditions are. Joey Dorado asks a good question here. What is the best dividend paying stocks that you can recommend for beginners? I'd say dividend paying ETFs if you want to go the dividend route, which we'll talk about that in a couple seconds here. But high dividend ETFs, I know Vanguard's is VYM. Also REITs pay higher dividend yields, but they're usually taxed at ordinary income tax rates. So they're taxed a little bit higher, but they do pay out higher. VNQ is Vanguard's REIT. But as the whole argument for and against investing in dividends, when I first started investing, I was like, oh, dividends are awesome. Like, it's really cool. I want a big, strong cash flow coming from my investments that maybe one day I can live off of. That's awesome. So I started investing in like VYM and VNQ, the Vanguard High Dividend Yield ETF, and the REIT. And I was like, oh, this is really cool. I'm getting a couple bucks a month, or I'm giving a couple bucks every 3 months, every quarter. I'm getting a payout from them. But the thing is, if you don't have like hundreds of thousands of dollars or millions of dollars to invest into high yield dividend or high dividend yield ETFs like this, the dividends really aren't worth it because they're not something that could, sustain your lifestyle. They're not something that could act as your only source of cash flow because they pay out like 3-4%, maybe 5% if they're getting really high. So if you invested $100 into there, you're probably only getting like $3 back, $4 back, $5 back every single year. Obviously, like 3, 4, 5% is awesome if you have $1 million invested because then you can get like $40 grand every year in cash flow. That's cool. But the thing about dividends, dividend yield ETFs especially, is they hold companies that offer dividends, obviously. And companies that offer dividends are companies that usually don't have great growth prospects otherwise. So they instead issue dividends to make their stock more attractive to investors. And the thing about dividends is how companies get them is they come from the company's retained earnings, and earnings, basically their net profits. And company has a choice here. They either pay these out as dividends or they reinvest them back into the company, into like R&D to help their company expand and grow bigger. So if a company has humongous dividend obligations, then they're not reinvesting this money back into their company to help improve their products, to help their stock price appreciate. So because of this, stocks that offer big dividends don't usually appreciate nearly as much as stocks that don't offer very big dividends. And if you're asking like, hey, why don't they just cut their dividends and reinvest these proceeds to grow their business? Cutting dividends is a last case scenario, worst case scenario for these companies because anytime a company cuts their dividend, it signals that their business is getting weak and investors flee out of the stock because they think it's a bad omen for things to come. Whether that's true or not, that's just how it is. So basically what I'm saying here is dividend yield ETFs, they don't appreciate nearly as much, or dividend yield stocks even, don't appreciate nearly as much as stocks that aren't as focused on paying dividends. And this is a good thing because, hey, I'd rather have appreciation over dividends because dividends are taxed every single time they're paid out. They're taxed no matter whether you just reinvest them back in the stock or whatever you do with them. They're taxed unless they're held within the Roth IRA or a traditional IRA or a different kind of retirement account. But if you're just in a regular brokerage account, dividends are always taxed whenever they're paid out. The thing about appreciation is it's not taxed until if you ever sell. So I'd rather have all my appreciation deferred so I can continue to build compound interest on this amount instead of having dividends that are paid out and taxed every year. So I prefer going with appreciation, especially when you're a younger investor, when you're just getting started, before you have the big bucks to put into dividend yield ETFs, because you avoid a lot more taxes and you earn a lot more money, even though it's an unrealized appreciation, than you do with dividend yield, than you do with dividends. And you'll notice it right away too. I've only been investing for probably 4 or 5 years now, and oh my gosh, have my VOO, S&P 500 ETF, VTI, Vanguard Total Stock Market Index ETF, Total U.S. Stock Market Index ETF, they have increased magnitudes more than VYM and VNQ have, although they haven't appreciated terribly. It's just not nearly as much, and I just wish I would have just put all my money into VTI and VOO instead of messing around with these dividend things. Rice Gobbler asks, is your end goal to quit your job and do TikTok full time? Doing content is phenomenal. It's a lot more fun than my day job, if I'm being quite honest. There's a lot of things, just at any 9 to 5, any day job, anytime you're working for somebody else, there's going to be a lot of aspects of the job that you just don't enjoy. And for me, there's a lot of those that I just don't enjoy. So if I ever reach the point, which my goal is to reach this point within the next couple of months here, where my income from TikTok and all the related social media activity is greatly outweighing the amount I'm bringing home at my day job, then I'll have to take a good look in the mirror and be like, hey, is this something I'm comfortable going full time with? If the cash flows are there, if I build up my Patreon, that's why I'm trying to build up my Patreon so much. It's not quite picking up steam yet, but hey, if you want to support me, you can go ahead and check out my Patreon. If I build something like that up where I get a couple hundred followers on there, maybe 1,000 plus followers on there, I get a good source of predictable recurring revenue. So I'm I have good, strong, stable cash flows from TikTok and all related things like Patreon. Making a lot more than I have my day job, and most importantly, I enjoy doing this stuff a lot more than I do going to work every day, and especially this time of year where I am the only person really responsible for preparing our firm's 150 plus tax returns every year. But let me tell you, I do not like preparing tax returns. So if this was my last tax return preparation season ever, I would not hate that. So yes, I would love to do this stuff full time, but it would have to make a lot of financial sense to do so, essentially. And let's hope we get there in the next couple months. I'm grinding every day, posting videos essentially every day, doing these live streams every day, because one, obviously I love doing it, I love interacting with you guys, but two, it's really favorable to TikTok algorithm. If you guys ever want to build your own TikTok accounts, every time you post a video, go live for 30 minutes to an hour afterwards, and your video is going to get a lot more views, a lot more traction. Jamin Bluin asks, I started a videography business. Any advice? Bring me on as a client, man. I need some help. There's especially in today's day and age, man, there's an endless amount of people that could use a good videographer, a good editor, a good anything in the content creation space. You can get everything from Fortune 500 companies need help with their advertisement production, a lot of small businesses. Honestly, probably where you're going to make most of your money is working with small businesses, cold outreach to them, basically find an email address you can send something to and be like, hey, I am a videographer. I'm pretty darn good at it. And for a certain fee, I will help you make a video that you can post on your social, or that you can use as a paid advertisement on TV, et cetera, et cetera. And then obviously there's creators like myself who are not particularly great at the whole videography thing and the whole editing thing, or maybe don't have a lot of time for it, and they could use help too. So hey man, if you want to work with me, I'd be happy to hear your pitch. So just send me an email. My email's in my bio if you think you'd help me out a little bit. Blake MCB asked, thoughts on SafeMoon? Am I invested? No, I am not invested. If I was going to put money in SafeMoon, I would just run down to the local casino and put money on a slot machine, because that's exactly the same thing. You're gambling your money with, especially these meme coins like SafeMoon, like Dogecoin, basically anything besides Bitcoin or Ethereum. It's really hard to justify investing in any significant amount of money into. And hey, if you have $100 that you want to throw in there just to see what happens, that's fine. You're just to let you know, the most likely scenario is this $100 will end up being worth a lot less than the initial $100 you put in there when you eventually withdraw it, because crypto has a lot of trading fees associated with it. So even if SafeMoon did like stay pretty stable and price wise, you would lose a lot of money due to transaction fees. And then these things are just so unpredictable. SafeMoon, I've been hearing about it for a week or two now. Has the hype cycle already matured? Is it going to get even bigger? I wouldn't bet on that. We already saw what happened with Dogecoin. It went up, 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 and then down, 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 down. Once people were like, hey, look at all this money I have sitting in Dogecoin that randomly went up one day. I'm going to sell this and take my money before it goes back down. So when people started selling, then it eventually went back down and became a self-fulfilling prophecy. So yeah, I like to stay away from these very gambling-like cryptocurrency tokens because I'm not a gambling man. I like to say hey, I've been to Vegas twice in my life and I have not gambled once. So I would, that's definitely not my kind of investment. I like to allocate my cash towards the domains that are most likely to earn returns consistently. And so far, it's been a pretty good investment. Oh, we got a lot of questions. Let me scroll back up here. Give me 1 second here. We got a lot. Yes, sir. Appreciate all y'all. Candy K72 followed the host. Love to see that. Mohammed Motar asks, hey, dude, I have a quick question. What is the best app to invest on? Funny enough, I'm partnered with them. I am a big fan of Public. You can sign up through the link in my bio and get a free slice of stock. The reason I do like them so much is because, one, their app is super easy to use. 2, they offer fractional share trading or fractional share investing by default, so you can invest in a slice of any stock, or basically any stock, basically any ETF for as little as $1. So dollar amounts don't have to be a barrier to you. And 3, they promote sound, safe, long-term investing, and they build their entire community around that. It's none of this day trading BS. They don't try to get you into options trading, even though that would probably make them a lot more money. They stay away from that stuff. They want to make sure you're focused on the straight and narrow, focus on investing into really sound, passively managed index ETFs or blue chip stocks even. They create an entire community around that. So yeah, I'd say, hey, check out Public. If you're a little more advanced, I do use Fidelity for my IRAs and for my main brokerage account. So so it depends on where you're at, but just app-wise, I'd say Public, bar none. Dwayne Lewis 714 asks, I have a traditional IRA, but next year I will invest into a Roth or split between the two. Question. Just time value of money wise, the calculations always seem to show that investing into a Roth is better for you long term because obviously all your investments grow tax free, and then when you reach age 59 and a half, you're able to withdraw all of your earnings, all your contributions, etc., tax free. So obviously this is a pretty solid tool if, for instance, your Roth IRA funds appreciate up to $1 million by the time you're 60. You can withdraw this $1 million just like it's like taking something out of your bank account. It's not taxed at all. So that's fantastic. Whereas with a traditional IRA, it's taxed at ordinary income tax rates. So who knows? Maybe you're going to be making a lot of money. Hopefully, if you listen to sound advice from Nick Talks Money, you're going to be invested into a bunch of assets that are going to end up paying out humongous dividends and cash flows when you're in your retirement ages. Maybe you're going to be in the top tax bracket, and maybe these will get taxed at 40% or whatever the hell tax rates are going to be in 30 years. And that's another good point. If you look at the history of income taxes, they've usually gone in one direction over the long term. The United States started off with zero income taxes, and I think didn't have any until the Civil War, and then took them away afterwards because they thought they were stupid and really only needed during wartime, and then they were re-implemented at the turn of the century. My timeline might be way off here, but it was something like that. And ever since then, they've just steadily increased and increased and increased and increased, and it looks like they're still going to keep going up. So you can bet that income tax rates are going to be a lot higher in retirement than they are today. So, that alone would say hey, Roths are a pretty good idea. And then I added on to that, Roths are also great because you withdraw your contributions whenever you need. So if there's an emergency and you need cash now, you can withdraw up to the amount of your contributions out of your Roth IRA and use that for whatever, with zero penalties, zero taxes, etc. But as for your question, it's hey, should I split between a traditional IRA or go into a Roth? I'd say, hey, depends on what your exact goals are. Would you rather save more money this year or make the best financial decision overall? If you just want to make best financial decision overall, it's probably better to go into a Roth, especially since income limits phase out sooner for Roths than they do with traditional IRAs. So, I mean, hey, maybe in a couple of years you won't even be able to contribute to a Roth anymore. So maybe it's better just to get that as full as possible now while you can and save traditional IRAs for later. But if you do like the tax saving benefits that traditional IRAs give you today, I mean, hey, maybe you prefer that. It really is a personal choice, but the best financial, just numbers-wise decision would just say, hey, put it all into the Roth. Don't want before ask, can you buy crypto while on EI? Not entirely sure what EI is. Please clarify that. Might be having a brain fart here. Machine says if you're taking advantage of your Roth IRA, you're missing profits for receiving tax. Yep. Your Abby is awesome, says hi. Hey, back. Had a nice little conversation here between Dwayne Lewis and Machine. Love to see that. Jack OVOXO, Drake fan in the building. Love to see that. maybe you're not. Asks, how do I become a successful investor? Yeah, I mean, honestly, investing, when you break it down, is really easy. You just need to consistently invest into index ETFs like VTI or ITOT or SCHB. Just consistently, like every single month you should be making a monthly investment, if not more frequently, and just make sure you have a set amount of money from every single paycheck that you're going to put towards investing. And just make sure you stay consistent and don't sell. And that's essentially all you need to do to be a successful investor. It really is that easy. Just buy index ETFs consistently and hold them for a long period of time because they're almost guaranteed to go up in the long run. I mean, if you look over the past 100 years or so, the total U.S. stock market has appreciated at an average of over 10% per year. So it's really impossible to lose if you just hold for a long time. Where people get tripped up is they think they can beat the returns of the stock market. Spoiler alert, you can't. I don't care how many TikTok videos you see about day trading. I don't care how many chart courses you've taken. You can't use technical analysis to beat the market. You can't pick individual stocks that are going to consistently outperform the market. You can't because professional Wall Street traders can't either. Professional mutual fund managers can't either. So just don't worry about outperforming the market. Worry about matching the market and indexing the market. And if a big dip occurs, like last year when the COVID crash hit, hey, don't sell, because if you sell, you're guaranteeing that you're going to lose. And you're making the reason you invested in those ETFs in the first place is because you thought that over the long run, the U.S. stock market would continue to go up. And guess what happened after the COVID crash hit? It steadily rebounded, and now today it's at all-time highs. So yeah, I mean, your bet would have still paid off if you just would have held and not sold during the dip. So, I mean, you hear this all the time, but hey, buy the dip, yes. And another thing you could think of is like, hey, don't sell during the dip, but don't sell ever, really, but especially don't sell during the dip. That's really all you need to do. That's coming from a licensed financial advisor, from someone who's worked in the industry for 4+ years, who's certified, has a finance degree, etc. I'm not I don't benefit at all from telling you this, other than like, hey, I'm giving you good information, and hopefully that comes back to benefit me eventually someday, somehow. But I'm not trying to sell you on anything, unlike these day traders selling you on courses that are these basically just get-rich-quick schemes. People selling you on different get-rich-quick cryptocurrencies. That's just not how it works. The thing about people who do get rich quick is they haven't built up the foundation of realizing what it means to actually build wealth. And how you actually build wealth is by investing consistently and slowly into basic passively managed index ETFs that are very low fee, and just holding these for the long term. If you do this, you are almost guaranteed to retire a multimillionaire, depending on how much you are investing. But if you can stay consistent with it, yeah, you will be successful and beat probably 95% of other investors. There's always going to be that small percentage that does just get lucky, that does invest in like something like Tesla at their IPO or something. But you definitely can't bet on that being you, because for as many of those that you do get right, you're probably going to get just as many, if not more, wrong. So yes, just track the market, consistently invest, and don't ever sell unless like you specifically need the money for something. Like, hey, you're buying a house. Like, yeah, okay, you can sell some stocks to get a down payment, but yeah, it's really easy when you think about it, or it's really easy if you don't think about it, but a lot of people overthink investing and have a lot of overconfidence. Overconfidence is one of the biggest and most painful and destructive biases that's prevalent in the world of investing and really in every world, essentially. Just be humble, realize that you're not going to beat the market, you're never going to outperform the market, you're not the next Warren Buffett, you're not the next Wolf of Wall Street. Just track the market and you're going to outperform basically everybody. Dwayne Lewis, thanks for another question. Where do I put $100,000 right now? Real estate or stocks? Man, that's tough because real estate, there's so many different individual market factors. Like right now, I mean, all around the country, but I mean, especially the area where I'm at, I live in a big metro area. I mean, in Minneapolis. It seems like real estate's really overvalued right now, but as a whole. But I mean, hey, I'm still trying to invest in it because if the numbers work out, then I'm gonna make an offer on a property. And basically, I mean, if you have $100,000, you probably only need $20,000 of that for a down payment, unless you've already bought a house before. Then maybe lower down payment mortgages may not be available to you. But basically, it depends. I know everyone hates to hear that. I would probably lean a little more towards stocks just because they're a lot less involved. It's a lot easier to be successful in the stock market. So if you don't have a real estate background, it's a lot easier just to, put money into index ETFs and let it ride. Don't touch it. You don't have to deal with tenants. You don't have to deal with finding a good deal, anything like that. But hey, if you are willing to put in the work to find good real estate deals, if you're a Bigger Pockets listener, if you're a follower of that, if you really know what you're doing, then hey, yeah, deals are still to be found out on the market right now. And there are some pretty decent cash flowing opportunities if you're able to play the hard game that is real estate. So essentially, stocks are the easy way out. You're still probably going to get a pretty good return on them. But real estate is the hard way out, but you could have the potential to build up really quick passive income streams. And you get the leverage that real estate provides. So if you bought a house that's like $400,000, if that appreciates by 10%, that's going to increase by $40,000. Whereas if you invested $100,000 in the stock market and that appreciated by 10%, it'll only go up $10,000. But then again, real estate only increases by an average like 3%, 4% per year. But yeah, like I said, it depends. The right answer is probably a mix between them both. And hey, I'd say, invest a large chunk of that just into the market right now. And then maybe if you haven't already, just, reach out to a real estate agent, see if they can start checking out some deals, start working on some multifamily unit. It's like, look for duplexes, look for triplexes, look for quadplexes. See if there's any out there that the numbers make sense. And if they do make sense, then hey, why not pull the trigger? Even though the market is super overvalued right now, there's always a deal to be found. Judge Warner 23 says, I think he reads comments from a different app while streaming on TikTok. I'm not even sure how I would go about doing that, but maybe one day. No, I'm still reading them from TikTok. It's awesome. The reason that you're like, hey, where is he getting these comments from? It's because I answer each comment with 15 minutes worth of discussion. So the comments just keep flowing by, and I'm still up here on the fifth comment of the video. I'm sorry about that. I'll try to keep more concise. Good morning, lads. Asks a great question here. Mutual funds or ETFs? Can mutual funds outperform the market? They can, theoretically, but 96% of them don't in any given year. That's a wonderful stat that it's nice to keep in your head. What mutual funds are is they are basically a fund, a pool of money, essentially, run by a hotshot asset manager, investment manager, and their whole team of investment analysts, and essentially their goal is to find an index like the S&P 500 and outperform that index by picking individual stocks. And you have to pay this team of people to do what they're doing. So you usually pay fees around 1%, 2%, 3% even, which in the investing world are super high because passively managed indexes that just track these indexes that they're trying to beat charge fees that are 0.03%. So a very, 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 very small fraction of what these mutual fund managers are charging you for underperformance against the market because 96% of them fail to beat the market in any given year. So just imagine how many of them can beat the market 2 years in a row or 3 years in a row. Essentially zero. The only reason mutual funds are still so prevalent and why they're pushed so much is because they make so much darn money for the people that are offering them. Like if Fidelity or Schwab or whoever, like TD Ameritrade, if they offer their own mutual funds, you can bet that their advisors are going to recommend that you invest in mutual funds before passively managed index ETFs. And you can bet that their standard vanilla recommended investments are going to be mutual funds. Like if they have an automatic investing tool that you're like, hey, like I'm an aggressive investor. I plan to retire in 40 years and I'm okay not investing a lot in bonds. What is my ideal portfolio? They're probably going to push you a bunch of mutual funds because they make the most money for that firm. It's not pretty, but that's just the reality of the investing space. And yeah, I would say, hey, stick with ETFs because most of them are passively managed, super low fee, and they're going to outperform the mutual funds even before you take the fees into account. Mutual funds, not worth the money. An old saying that financial advisors love is you get what you don't pay for when it comes to investing. The lower the fees on investment, the better it's going to perform, essentially. That's really all you can get. George Warner 23 says he doesn't read these comments. Wrong again, my friend. Grab444 asks, what's the best way to invest at the age of 50? Wisely. Sorry. It really depends on your goals. Depends on how much longer you want to work. I mean, if you're someone who's looking to retire at like age 55 and you're going to need this money really soon, you'd want to invest into safer assets. Maybe invest into some fixed income. Still ETFs are still a pretty good play because you're going to need something that's going to appreciate over the long term in retirement. You have to balance that with how much risk you're willing to take, how much money you're going to need to take out right away. In all reality, if you're an average American, you're probably going to work until at least you can qualify for Social Security at age 62. So your time horizon is still over 10 years. So I'd say, hey, if you don't want to get involved with real estate, anything like that, anything active like that, you just want to invest into the market and, hey, what's the best way for me to invest in the market? I'd say, hey, just invest into the same thing, total U.S. stock market index ETFs. They appreciate an average of 10% per year, but obviously not every year is going to be that. There's going to be some years where they go up 20%, some years where they're 5%, maybe even negative. Your investment horizon is still probably 10 plus years, so that's a good safe bet that in 10 years the total U.S. stock market ETFs are going to be worth more than they are today. When you start getting closer to retirement, you should start doing a little bit more analysis. This is where it does pay to actually meet with the financial advisor in person so they can see your individual scenario, your individual numbers, your individual goals, and they can give you a solid plan. It's like, hey, invest X% into fixed income just because you're going to need this money within the next 5-10 years, and then keep this amount invested in stocks so your portfolio can still grow over time and then continue to provide you income throughout your entire retirement. CCC Real Estate asks, do you do any day trading? Sorry if you already talked about this, just coming in. No! Much like mutual fund advisors, day traders cannot beat the market. I'd say their percentage of success is much lower than mutual fund advisors even, because 99% of day traders end up losing money. You simply cannot pick individual stocks and expect to outperform the market, and that's even over the long term. Over the short term, you just have no idea what the stock market's going to do. There's going to be an article about Dogecoin that throws off the entire U.S. stock market, makes investors lose faith for an entire week. And if you had an options contract expiring in 3 days, that's going to screw you over. No, you can't. I don't care how many people on TikTok are telling you like, hey, I learned how to read charts and you can buy my course for $500 and I'll teach you how to do it too. No, that's complete BS. You can't read charts. You can't do technical analysis. You can't pick penny stocks based off of your gut feeling and expect to outperform the market. If you want to beat basically everybody that day trades, just invest into index ETFs and leave your money sit there and just keep investing. You're going to outperform all these people who spend hours upon hours a day just to maybe break even, but probably lose money and pay a ton of taxes on any gains they actually do end up making. No day trading. No day trading. Stay away from it. No. Love hearing the sound advice, says William Kelly. Love it. Preach it on the S&P 500 ETF, says William. Yes. Dylan Walker 06 says, hello, friend. How could I make money in grade 8? Any tips? Yeah, so when I was I'm burping again, though. These live stream burps do not fail. So when I was around your age, I was about a year older than you right now. I was in 9th grade, and I started a YouTube channel. And as like a 9th grader, I was like, hey, I have a ton of time on my hands because I can't legally get a real job yet. And, I like playing video games, and this whole YouTube thing has seemed to be pretty successful for some people who just play video games and post about it. So I was like, hey, I'm going to put a ton of work into this. I'm going to record a bunch of stuff on like Minecraft back in the day and post a bunch of this stuff on YouTube. And I started doing that, started being really consistent with it. Much like how I built this TikTok channel, I just posted as much as I could, interacted with commenters as much as I could. And eventually I started making a good amount of money off of that. So, I mean, hey, if you're willing to put in the hustle and do something non-traditional like that, like go into content creation, the internet is literally a gold mine. If you can figure out something that valuable that you can provide to people, and my value back in the day was just entertainment, and I made cool stuff on Minecraft essentially, and I was entertaining when I was like playing Minecraft and stuff. If you can find a way to provide value to people on the internet, the scale is like literally unlimited. Like right now, like, hey, if you look at the people that are following me, I have like 300 something thousand people that are following me. That's absolutely insane. And at my day job, there's like 150 people, like maybe 200 clients that my firm works with as 3 people. And I have reached to millions and millions and millions of people through the internet, essentially. So, I mean, hey, if you can find a way to provide value on the internet, that's awesome. And another good thing about this is usually the internet businesses take a lot of grinding, a lot of time up front before they even start to pay you anything. I didn't see $1 from TikTok for like 3 or 4 months until since when I started creating it. I started earning a couple dollars that very first month. I think I didn't see $1 until like November or December. But since then, it's grown pretty well. So you have a lot of time to put into something that you're passionate about, and that's cool. But also, if you just wanted to like say like, hey, I just want to make money today. I want something that's guaranteed, something that's going to pay out well, and something that also could scale a little bit theoretically. Something I always recommend to people is like, hey, do some. Let's see if we can get some light back here. Nope, still too bright out. But see if you can do something like, hey, start like a lawn care business. Go knock on your neighbor's doors and be like, hey, can I mow your lawn for like $20, $30, $40, something like that. And 1, people hate doing this stuff for the most part, so they'd be happy to pay you to do it. And 2, you're the friendly neighborhood kid. They'd love to help you out. And hey, if you do a good job, this is recurring business. You could probably mow someone's lawn, I don't know, what is it like? Once or twice a month, and if they think you're doing a good job, they'll keep hiring you back, and they'll recommend you out to their friends who will also pay you the same amount of money to mow their lawns. And before you know it, you could be making like $30-$40 in an hour, and maybe, hey, book a couple lawn trimmings that day. You make a couple $100 every day, and if you just keep building this up, maybe business will get so busy at one point that you can hire out employees. I mean, there's countless examples. If you see like the founder stories of a lot of like founders of successful startups, successful businesses, a lot of times they're like, hey, yeah, I mean, my entrepreneurial ambition really started when I was like in high school or in middle school, and I created my own lawn care business that scaled to doing 6 figures in revenue after a couple of years. So yeah, I mean, hey, you could do something like that. That's basically guaranteed to make money, but it won't be the most fun thing. I mean, I don't know anyone who really loves mowing lawns. Or you can do something that's even more scalable, but it's not guaranteed to make you money, like YouTube, like TikTok, like something like that. But hey, you're young. You have plenty of time to learn, to fail, to succeed. And hey, most importantly, if you fail, you don't need to worry about putting a roof over your head. You don't need to worry about putting food on the table. Your parents are hopefully providing that all for you. So hey, take big swings. Go after something you're passionate about. If that doesn't work out, maybe try doing something that'll make you a lot of money. We'll see. Cesar Rios, 817 says, dropping 19K on Microsoft Monday. I don't know if I'd be investing that much into a single stock, but hey, more power to you. I'd rather put that into VTI. Winning teams. Geez, you're on the winning team, says Crazy Boy. Not sure exactly what you're talking about, but love it, yeah. Manaba, the burps are back. 86 says hello. Garrett Orr, great question here. What are my thoughts on Doge? My thoughts are stay far away, because by investing in Doge, you're essentially just putting money into a slot machine and hoping that it pays out in the end. Except the fact with Doge is you just have no idea when the right time is to sell. Well, at least with the slot machine, you put money in, you spin the thing, and it either gives you money back or it doesn't. With Doge, it could go up by 100%, and you're like, oh, cool, it's going to keep going up. And then it goes down again, and you end up losing money. I don't like investing in things like Doge because it literally is gambling. The coin has literally zero inherent value. The only value that it has is given by people who think it's a meme, who think it's funny to invest in. And as soon as the media coverage stops, it's going to stop holding value. So I would stay as far away from it as possible. if you do want to invest into crypto, I mean, hey, go with the two big dogs. Go with Bitcoin, go with Ethereum, and even then, don't invest more than 5 to 10% of your net worth into there because it, as a whole, is a very volatile asset class, especially when you invest into something as crazy and as erratic as Doge. Sup, dude? Says Noob Master. Hey, how's it going? Mohammed Motar says, answer me, best app to invest on. Hey, man, I answered you earlier. Public, link in my bio. I won't go through the whole spiel again on there, but hey, if you're looking to invest in the best app possible, especially for beginners, Public, link in my bio. It's the very first link after my Patreon. It has the little blue emoji on there. Colin Raup says, thanks, man. Hey, thank you. Appreciate you. So you're going to be doing a couple more questions on here. Then I got to get back out and edit some more TikTok videos. So they're ready to post this week. Hey, sup from Texas, says Eric the Solar Pro. Hey, how's it going? Sup from Minnesota? Let's see. Piper asks, can you explain how to connect to your parents' credit cards before you're 18 for a good credit score? Yeah, so I have a couple videos on this. It is called getting added as an authorized user on one of your parents' credit cards. And I always say, like, hey, find your parent that has the best credit score. Make sure they pay off their credit card balance in full every month. If it doesn't, then it will hurt you more than it helps you. But if they do pay off their credit card balance in full every month, ask them to reach out to their bank and just say, hey, can I add my son, add my daughter as an authorized user on my credit card? And they'll say, yeah, sure. And they'll ask if you want a credit card or not. And it's probably up to your parent to decide whether they want to do that or not, but it doesn't matter. And then that's essentially it. You get added as a name on that credit card account, and as long as your parent makes their payments in full every month, then your credit score is going to go up and keep going up. And by the time you're 18, you'll be able to qualify for some really great credit cards, get really good rates on student loans, and save a lot of money over the long run. Carl Mack 2021 asks, how much does TikTok pay me? Hey, if you want to see exact numbers, I do a monthly breakdown of all of my income, so including my day job, including everything from TikTok, including everything from advertisers. A full monthly breakdown of that on an Excel spreadsheet is available on my Patreon if you want to see that. But I would say, I'll give you a little hint here from the Creator Fund. Maybe only a couple $100 a month. I mean, ads on TikTok are not nearly as lucrative as ads on YouTube. I mean, if I got the same amount of views on YouTube as I do on TikTok, man, I would probably be pulling in like 5 figures a month. But no, ads, the Creator Fund does not pay out all that much. If maybe for someone who posts and gets like 1 million views in every video, yeah, it'd be a good source of income. But for someone who only does, 1 million views a week, maybe on a good week, it's not super lucrative, but it's better than nothing. But hey, the real money comes from the advertisers, and hopefully one day from my Patreon. If you want to check out my Patreon, link in my bio. But yeah, once you get a larger following, especially in the space that I'm in, which is financial and tax education, personal finance, advertisers pay pretty well. So yeah, we're doing pretty decent there. We're really picking up some steam in that department. If you want to see actual numbers, go ahead and check out the Patreon. Is starting a mechanic shop smart? Asks Mike Cockert. Maybe. Oh, that's I see your name. Mike Cockert. Man, you got me. But yeah, is starting a mechanic shop smart? Hey, if you're a good mechanic, if you have good experience, if you are starting a shop in an area that maybe doesn't have a lot of competition, yeah, it's fantastic. I mean, it's just like starting any business. One, are you competent at it? Are you good enough at it so you get repeat customers? Two, is your market oversaturated with mechanics right now, or is it undersaturated? Is there a business opportunity in whatever market you're thinking about? I don't know. Do a full market analysis. Do a realistic assessment of your own skills. See if you'd be up to the challenge, especially if starting your own business. And hey, if that's something you love to do, and if you think you can manage employees, build a business, deal with the accounting, deal with setting everything up, setting up an LLC or setting up a corporation. Yeah, I mean, being a business owner is one of the most fulfilling things you can do in your life if you like what you're doing. So I'd say definitely give it a good think. Jenna Marshmallow, are you going to do any videos on buying a home? I don't think I'll ever be able to own one. Yes, I did make a couple videos on home ownership a couple months ago. I guess it's been a while. I should probably start doing them because I'm actually in the process of searching for my own rental property. right now. So I've gotten a lot more hands-on experience with that process. But hey, if you're dissuaded, if you don't think you're ever gonna be able to buy a home, I would say, hey, it's a lot easier than you think. It requires a lot less money than you think, I should say. As long as you have a decent credit score, your credit score should probably be above 640 if you want to get good rates on a mortgage. But if you're a first-time home buyer, you can literally, like, the down payment, you're probably like, oh no, I need to put a 20% down payment down on a home before I can even think about owning one. No, you don't. If you're a first-time home buyer, you can put down as low as 3.5% with an FHA loan. Although those are also harder to get cleared. There can't be peeling paint. There can't really be anything wrong with the property. I learned that myself going through this home ownership process or the home search process. And there's a ton of down payment assistance programs. There's literally probably hundreds of programs across the country, if not thousands, that offer you tens or maybe thousands, tens of thousands of dollars in down payment assistance. And a lot of times these don't even have to be paid back ever. So you're literally getting like a free $5,000, free $10,000 to put down towards a down payment. Realistically, as long as you have like $10,000 in cash, you could probably own a home basically anywhere in America outside of maybe California. That's not a good place to be buying a house value wise. But anywhere else, you should be able to, as long as you have like 10 grand in your bank, if you can save with $10,000, you can definitely buy at least some form of home. I'd recommend that you reach out to a mortgage officer at a local credit union and a real estate agent. They can really help walk you through the whole thing for free. You don't pay them anything. Mortgage officers only get paid if you get a mortgage through them. So, they're going to be trying to be as helpful as possible, and good ones will tell you everything possible that you can do to save money on a home, save money on a down payment, buy something for as little money as possible. And the real estate agents, the seller of the home pays for them, so they're free to use for you, and they are a fantastic resource because these people dedicate their entire lives to real estate, so they know a lot about it. Home ownership is a lot more attainable than a lot of people realize. Bond521 asks, how aggressive should your portfolio be at 23 years old? Pretty darn aggressive. As far as equities versus fixed incomes investment splits goes, as long as you don't have any big purchases coming up in the near-term time horizon, like unless you want to buy a home shortly in the next couple of years or make any other big purchase like that, I would say, hey, invest completely into the total U.S. stock market ETFs like VTI, ITOT, SCHB. You can even go with S&P 500 ETFs like VOO, IVV, all that fun stuff like this, and basically just buy those, let them ride, consistently invest in those, and you're going to end up doing better than 99% of people that are investing in the stock market, especially people that are day trading, especially people that are picking individual stocks. That's how you win, and that's basically how aggressive you should be. Just stay away from bonds, stay away from any fixed income unless you have a big purchase in the near-term time horizon. Tastefly asks, what do you advise if the investment time horizon is 5 years? I'd say, hey, for now, put all your cash into big, long-term, broad-based, low-fee index ETFs like VTI, ITOT, SCHB, big total U.S. stock market index ETFs that I just mentioned. And as you get closer to maybe like, hey, in 5 years, you want to buy a house. As you get closer and closer, first of all, make sure you have a good idea of the amount of cash that you actually need for like a down payment, for example. And maybe as the years keep getting closer to that, just keep allocating more and more and more towards fixed income assets like maybe money market funds or certificates of deposit or high yield savings account. And basically a year out, you should have basically all of your money that was in the ETF should be into safe fixed income instruments like money market accounts, in certificates of deposit, or high yield savings accounts. And essentially just be aggressive right now, and then start scaling it back year over year until a year out. It should all be in a safe spot. Jack OVOXO asks, thoughts are thinking of getting my finance degree. Thoughts? Yeah, if it's a space you're interested in. Hey, you're on Nick Talks Money live stream right now, so you have to be at least a little bit interested in finance. I have my finance degree, and it's definitely it's one of those degrees that does pay for itself, whether you like what you're doing or not. There's a lot of paths down the finance tree or down the finance career tree that are a lot more focused on making a lot of money and a lot less focused on doing a job that you actually enjoy. So that's something that you have to take into consideration. But hey, there's a lot of awesome places, a lot of awesome job opportunities available in finance that are really a combination of both, that are pay you a lot of money and are things that you enjoy doing for the most part. So you could definitely go a lot worse than getting a finance degree. Dwayne Lewis 714 says, got my money's worth and didn't even have to pay you. Go. Yes, appreciate you, my man. Bubba G says, what brand is your wig? Man, you gotta come out here every time and ask me if I wear a wig. That's funny. Shrez1 says, actually I have no idea. He's asking tell me what's the difference between Bitcoins and Bit tokens. I'd say they're probably separate investments, but I'm not entirely sure here. Boston Gamer 8380 asks, is my name Nick? And if so, do I talk money? Yes, my name is Nick, and I'm talking money right here for you. Actually, if you want to get into the weeds here, I talk money on TikTok, on Instagram a little bit, at Nick Talks Money on there as well, and on Patreon, which you find through the link in my bio if you want to help support me a little bit financially and help me turn this thing into a full-time gig eventually. Lil Beast 322 asks, how can you earn money with stocks the best way? And thanks! The best way to earn money with stocks is to bet on the entire stock market over the long term. And basically buy and hold broad-based, low-fee index ETFs that invest in the entire stock market like VTI, ITOT, SCHB. Buy them, invest in them consistently, and hold for the long term. If the market goes down, don't sell them, just buy more. If the market goes up, don't sell them, just buy more. That's literally all you have to do to be a successful investor and to outperform essentially everybody else that's investing in the stock market. Basically, the more complicated you try to make it, the more mistakes you're going to make, and the more bad decisions you're going to make, the more bad investments you're going to make, and the worse off you're going to do over the long term. Investing really is easy. It's just more so the hard part is controlling your emotions, controlling your behavior, and just hammering into yourself that, hey, you're not smarter than the market. You're not going to outperform the market. You're not going to pick stocks that are going to outperform the stock market. You're not going to day trade better than the stock market's going to do. It's just stop. If you find yourself coming to that or find yourself thinking those thoughts, just hey, slap some sense into you. That's essentially it. F1XXY asks, what is the best thing to invest at like 14? Your investment options are limited at 14. You would need to have a custodial account if you want to invest in stocks. So a custodial Roth IRA or custodial brokerage account if you wanted to invest into stocks at 14-year-old. And basically what that means is that your parent has to co-sign your account. So it's pretty easy to do. If you want to do that, just say like, hey, Google like Fidelity, Schwab, or Vanguard, and then custodial brokerage account or custodial Roth IRA. But to contribute to a Roth IRA, you need to have generated earned income in any given year. So, I mean, that's something that could stop you from investing there. But hey, you're 14, you're super young. Invest in yourself. Keep learning. You're doing a great job here. You're on a Nick Talks Money live stream. Obviously, you're learning a lot. Think of something that you enjoy doing in your downtime and see if there's a way to monetize it. The best thing you can do when you're 14 is learn how to hustle, learn how to make money on your own. And without going down a traditional job path. Because, in most places, you can't even get a real job at 14. What I did, if you're early in the live stream, I started a YouTube channel when I was 15 and ended up making a good amount of money. I paid for a lot of my college by just posting videos of me playing video games on YouTube. And that's something that required a lot of time, a lot of effort, especially up front before I started seeing any money. And hey, you're young, you have the opportunity to put a lot of your time towards something, especially with summer break coming up here, where basically you're not going to be doing anything all day. You hang out with your friends, and then what else do you do? You could start doing something like that. Start really building something that you're going to be really grateful that you did long term. User Not Seen says, hey everyone, drink water right now. Hydration is important. I agree. Here we go. Take a swig. Water break, done. Hopefully you all drank some water. Okay. Let's see. I think I got lost here a little bit. We'll start right here. Jesse asks, will my bad credit affect my parents' credit? So I'm guessing you're asking, okay, I get added as an authorized user on my parents' credit card. If I don't have a credit score right now, if I have a bad credit score, will this negatively impact my parents' credit? No. The only thing that would impact the credit, the only thing you could do to negatively impact their credit score is like, say, you got added as an authorized user on their account, so your name is on their credit card as well. If they issue you a credit card in your name tied to that account, and then you go off and go on a spending spree with that credit card without your parent knowing, then maybe they could prevent your parent from paying off the balance in full in any given month. And if they don't pay off their balance in full in any month, then their credit score will go down. And it's tied to your account too, so your credit score will also go down. So really, the only way that you would negatively affect your parents' credit score is if you cause them to not be able to make the credit card payment in any given month. That's essentially it. Otherwise, no, your bad credit score won't affect them. If you're adding as an authorized user on your parents' credit card, you probably don't have a credit score at all to begin with. So that's not anything to worry about, thankfully. Lucy the Borner Tool asks, just wondering, can a person invest when they are under 18? I want to invest. So you might have heard my answer to the person probably 2 minutes ago. If you're under 18 and you just want to invest into stocks, what you need to do is open up a custodial account. Basically, just have your parents sign on. It's really easy to do. Just Google something like Fidelity, Schwab, or Vanguard, followed by custodial brokerage account or custodial Roth IRA. But like I said earlier, if to contribute money to a Roth IRA, you do need to have earned income. So if you're working a job, then that's fine. But if you aren't, then open a custodial brokerage account, and then you can invest in stocks through there, and then it'll transfer to 100% account ownership over to you, either between when your age is 18 to 22, depending on what state you live in. Jenna Marshmallow asks, I can't afford market, and we only have 10% battery left on the phone here, so we do have to wrap it up here quick. But Jenna, I would say, hey. Ask yourself this question. Do you know that you can't afford a home right now, or do you think that you can't afford a home right now? And what I mean by this is like, hey, have you reached out to a mortgage officer? Have you reached out to a real estate agent? Have you actually ran the numbers with them? Have you seen what down payment assistance programs are available to you? Have you seen what loan programs are available to you? Because like I was saying earlier, there's a thing called an FHA loan where it lets you put down as little as 3.5% down on a home. So if you wanted to buy a $100,000 home, I know it's not really realistic in most markets, but if you want to buy a home for $100,000, you'd only have to put down $3,500 in cash to buy that house. And in a lot of different places, you can actually qualify for down payment assistance. So it's likely that you could put down $0 to buy a house, especially if you're a lower income person. If you make under, I know at least in my state, it's like under $70,000 a year in income, you're able to get access to a lot, like $20,000 of down payment assistance, and most of it you don't even ever have to pay back. I'd say reach out to a loan professional and just ask them to run the numbers for you, because there's probably an option out there for you. There's just so many different government plans that help you, especially buy your very first home. And if not your first home, your second home. There's probably something out there for you. Okay, we're gonna wrap up here unless there's something real quick and cover. Looks like that's about it. So hey, if you guys haven't seen most recent video, go ahead and check that out. Leave a handshake emoji down there in the comment section. Just let me know that you came over there from the live stream. If you like the video, I'd appreciate you giving it a like, giving it a share. If you don't want to share it with anyone, just hit the share button, hit copy link. Watch the video through a couple times, help me with the algorithm. I'd really appreciate it. And hope you guys have a wonderful Sunday evening. If you want to see any exclusive premium offerings from myself, you can go check out my Patreon page, link in my bio. If you want to get started investing, check out Public or Fundrise in my bio. And hope you guys have fantastic Sunday evenings. Probably be back on the live stream tomorrow. Probably be back on Tuesday. We're gonna be live streaming a lot because hey, we're really on the growth grind right here. Hey, 500,000 followers within the next month and a half. Why don't we say? Let's do it, guys. Hope you guys all have great nights and great weeks. Take care.